Hey traders, Jason here from Leavitt Brothers. So I'm going to do an update to my State of the Market series, but this one's going to be a little bit different. See, normally I show the indexes and I show a bunch of breadth indicators, and combined they paint a pretty good picture of what's going on in the market and where we should be positioned and how aggressive we should be, etc., etc. But the indexes and indicators for the most part have lied to us. They haven't given us the true picture of what is really taking place. Our best indicator right now, our best indicator at all times, is to actually just look at like 500 individual stocks and get a gauge of how well the market is acting. Are stocks following through? Are they breaking out? Are they failing? Are they respecting moving averages? Just how are they acting? Is the market acting well per many individual stocks, or does something seem to be off? Okay, that's always our number one indicator. And right now, that is the only indicator that we could really rely on, because it's the only one that's actually told us truly what's going on in the market. So what I'm going to do here is I'm going to show mostly individual charts to give you an idea of what the state of the market is, how we should be looking at the market, how we should view it, etc., etc. I am going to cover a couple indicators in the middle, but for the most part, I'm going to show individual charts to kind of paint a picture of what is taking place. All right, let's get through it. All right, so this is, generally speaking, this is the market that we've been dealing with. Okay, here is Apple. This chart goes back to the middle of December, but here is Apple as of like the middle of December. Strong stock, trending up. 2, 3, 4 steps forward, 1, 2 steps back. The trend obviously goes from bottom left to top right. The trend was up. No reason to be anything but long. At Leavitt Brothers, we've played it. We had it on our list here. We've had it on our list in other places. Overall, the stock has done well, and it's helped the market. Here is Google. Same thing. Bottom left, top right. Nice steady trend. Looks good to me. So per this, market was in good shape. Microsoft, same thing, trending up, several steps forward, 1 step back, got a little bit of a dip April, May, a little bit of a dip in September. No big deal. That's pretty much normal, but moves from bottom left to top right. Here's Nvidia, same thing. Bottom left, top right. Obviously, the trend is up. Now, because these are the mega caps, these are the highest market cap stocks in the market, and because most of the indexes are market cap weighted, these stocks have an outsized influence. So because of that, because these stocks were doing really well, the indexes did really well. So here's the S&P 500 over that same time period. Obviously, the trend was up. There's a couple reactions back to the 50-day moving average. One bigger dip in September, early October that was easily recovered from. New highs November, new highs in November, and then a dip to the 50 in early December, and then moved up again. So because the mega caps were doing really well, the S&P told us the market's doing well. Trend is up, it's strong, it's healthy, stay long. Okay, here's the Nasdaq chart. A little bit more volatile. The dips are bigger dip in May, bigger dip in September, but the trend was still up. So because the big cap tech stocks were doing so well, the index charts were doing so well. So we were led to believe that the market was in good shape, it was healthy, and that we should continue to play the long side. But while this was taking place, Upstart, which had posted a big gain, was already well off its highs. It had more than gotten cut in half. DOCN, same thing. It hadn't gotten cut in half yet. But a strong stock trending up that had done very well and paid us well with some breakout plays, it had fallen a big amount off its high. Affirm, same thing. New high early November, and then it got crushed pretty badly. Next up, GLBE, printed a new high, printed its highest level in late September, pulled back, never really recovered. Net was a can't-miss stock in October, just trended up and up and up as it doubled, and then since then it has given back about 30% of its gain. DLO, same thing, went public, did really well, was one of those hot stocks, constantly talked about on social media. It has given back, it has gotten cut in half and has traded all the way back down to its IPO level. Okay, so while Apple, Microsoft, Google, Nvidia were doing really, really well, and the indexes therefore were doing really well, beneath the surface you had some high growth tech names that had already topped and were already in relatively big downtrends. And while this was taking place, Coke, which had traded sideways for many months, was breaking out on strong volume. Pepsi continued to trend up on pretty good volume. And Procter & Gamble just kept pushing higher and higher and higher day after day. And CVS broke out. It broke out in late October, consolidated, came back and tested its 50, and then it moved up to a new high. Okay, so mega caps doing well. They painted the index charts to make us believe the market was in good shape, but beneath the surface there was huge rotation out of growth stocks and into these safe haven staples such as Pepsi and Coke. All right, let me show a couple indicators that highlight what was going on further. All right, so what would I have here? What I have here is up top I have the Nasdaq. In the middle I have Nasdaq 100 stocks above their 50-day moving averages, and at the bottom I have Nasdaq stocks above their 50-day moving average. Okay, so what happened was, starting at the beginning of 2021, market was trending up, as you can see. And while this was taking place, the percentage of Nasdaq 100 stocks above their 50s was holding pretty steady, just oscillating in a range above 70%, which was great. Moved up, moved down, moved up, moved down. That's perfect. That supports the uptrend. But while this was taking place, the number of Nasdaq stocks above their 50s was slowly declining. Now, this is fine because it's fine at first because there's a lot of low-quality stocks at the NAS that probably should not be publicly traded. So it's actually fairly normal for the market to do well, for the number of Nasdaq 100 stocks above their 50s to hold up, but there to be some deterioration beneath the surface. But we tend not to really care about that because we don't care if the low quality $700 million stock drops off. Okay, then the Nasdaq continued moving up, but the percentage of NAS 100 stocks above their 50-day moving averages broke down below 70% and never recovered. And while this took place, the number of NAS stocks below their 50s or above their 50s continued to decline. Okay, so you look at this where the market traded up here, we had some deterioration here, but as long as the big cap NAS stocks were holding up, that was fine. But then the NAS continued to push up. We continued to get more deterioration here, and this time percentage of NAS 100 stocks above their 50s actually declined. Okay, so this is a huge problem. The market is not going to continue trending up if this is going to stay down here. Okay, we need prints up here in order to confirm any type of uptrend. Unless we get prints up here, there's no way the market's going to move up. It's just not going to happen. And now we're dangerously close to the 50% line. And if we get a drop here, then it's then it could be lights out. Okay, so I said at the top that it's okay if NAS stocks above their 50 trend lower at first, but if it continues for an entire year, as is the case, and the current print right now is over here is 27%, it's okay if that drops from 75% down to 65%, down to 50%. That's fine. But 25% is getting to the point where this isn't going to move up over here, while this is below 70 and this is so low. Okay, let's look at another one. Here is the NAS up top. We got NAS new highs in green and NAS new lows in red, and then the high low below that. So I want to just point out some things. So we had a dip here. Okay, no big deal, just a pullback. Okay, it lasted a couple weeks, and you barely had a drop below the high low, barely dropped below zero, and then it recovered. Okay, a little bit of a pullback here. We got a bigger drop below zero. Okay, and then a recovery. And there was a little dip there and a little dip there. Okay, we start to get in here, and we're starting to get more dips, and the dips are a little bit bigger. Even though the index was trending up, this little pullback resulted in a move below zero. And I'm not lining it up right. It's that one. This little drop here resulted in another dip. this little dip here resulted in an even bigger dip, okay? So whereas over here, the dips were shallower and the market recovered soon after, over here, we're barely getting, the Nasdaq is barely moving down for just a couple days, and we're getting bigger drops below. So if I fast forward over to the last month, we have the Nasdaq over here, higher high, higher, that's a new high, that's a new high. And while that was taking place, the high low dropped below zero, and didn't just drop below zero and then recover, it dropped below zero and fell a lot. And it still hasn't recovered. So we've had an entire month, actually we've had about 6 weeks of prints below zero. Okay, so we started to get some warning signs over here when very, very little dips over here caused the high low to drop. And now we have a major warning sign where the Nasdaq was at its high and you had a huge drop in the high low. Okay, and there's been no recovery. So over here we had recovery, 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 recovery. Over here, zero recovery whatsoever. Okay, so we have to start treating the current market different than in the past. In the past, we could just buy dips. Okay, market's trending up, it's up, it's trending up, it's healthy, it's this, it's that. We can just buy dips and just business as usual because the indicators would cycle down and then they recover. But right now, like this is let me erase these. Just to review, it's like this pullback here resulted in this barely moving below zero, and then this move here resulted in a gigantic move below zero. So the market we're dealing with right now is different than the market we dealt with for most of 2021. Okay, so let me go back to the Apple chart and the other big cap stocks. So here's Apple as of Friday's close. Okay, for the first time since back in early November, we've gotten 2 consecutive closes below the 21-day EMA. Okay, it's starting to break down. This is like one of the strongest stocks and most important stocks out there. Finally moved below the 21, starting to break down. Here is Microsoft. It took out a support level on Wednesday, followed through on Thursday, and couldn't really recover much on Friday. Here is Google. Similar situation. Took out a support level Wednesday, could not recover. Here is Nvidia. It's now in somewhat of a confirmed downtrend. It's got high, lower highs, lower lows. It's not a total loss situation. It's still, stock's still doing well overall, but it's starting to form what would be considered a topping pattern with lower highs and lower lows. It is traded below several key moving averages. And over the last 6 or 8 weeks, it is trended down. Here's Amazon, which I didn't show before. It did not attempt to make a new high over here with an S&P and Nasdaq. Instead, it was trending down, and now it's at a long-term support level with a lot of open space below. Okay, so the question that I want to leave you with is. So first the big guys, the generals, the big cap tech stocks were doing really well, and because of that, the S&P and Nasdaq were doing really well. But beneath the surface, there was obviously some rotation out of tech and into stocks like Coke and Pepsi. And so my question right now is, what happens if Apple, Microsoft, Google actually correct? Okay, they're not immune. You go back and look at their charts, it's 10, 20, 30% pullbacks are actually fairly common. They happen. We're kind of spoiled because the market's been going up for so long and it's been so strong. What happens if they actually undergo a very normal 10% correction? What if they actually have a 20% correction? Okay, it's very normal. Hasn't happened for a while. But if some of the growth names are already 50 or 60% off their highs, and the indexes are doing well, what happens if Apple actually falls 10 or 15%? What happens to those growth names? Are they going to get cut in half again? Okay, so I'll leave you with that. Okay, the market, there's obviously been some rotation going on. You got to be really careful out there. You don't want to pick bottoms in some of these stocks. The market right now is different than it was in most of 2021. So I don't think you could have the opinion, be of the opinion that you could just buy dips and, hey, here's a growth name that was hot last year and now I'm able to buy it at a discount. So this is great. I'm going to buy it. we're probably not at the bottom. We might not even be close to the bottom. Okay, the market, the indicators tell us that this dip that's taking place is different than previous dips that we've had the last year and a half or so. So I will leave you with that. Hope you got something out of this. I will see you next time.